Well, to summarize the conventional policy framework, it assumes that people expect that any expansion in the real value of government debt, for whatever reason, will eventually be met by higher taxes or possibly lower spending on transfers. So in the Ricardian equivalence case, if you cut lump sum taxes today, you raise them in the future. Higher government spending gets financed by higher present value of taxes. And as we just went through, an open market sale of treasuries will have to generate higher taxes in the future, whereas an open market purchase would generate lower taxes in the future. Now, this might be a reasonable assumption in well-developed economies in normal times, but it's much less reasonable, say, in emerging economies where they may not have the infrastructure to run policy this way, or going forward in advanced economies who are facing extended periods of fiscal stress. It may also not be so reasonable to assume this. And I think as we've seen in the United States, and even in certain countries in Europe, it's not a foregone conclusion that anytime government debt expands, the taxes will rise in the future to support that expansion. So let's talk about an alternative framework for thinking about how price level gets determined. You need to remember that unlike monetary policy, fiscal policy is not made by technocrats who don't have a political agenda. Fiscal decisions are intrinsically political. They're made by elected officials who are responding to their constituents. And recently, U.S. fiscal policies have not at all been consistent with this usual or the conventional framework. In 2011, we got a debt ceiling fiasco. The Congressional Super Committee that Obama appointed ended up delivering sequestration. There was a refusal to raise taxes despite rapidly growing debt. We then got a fiscal cliff, which delivered another sequestration. And this year we saw yet another debt ceiling fiasco. And meanwhile, the unfunded liabilities that are associated with our aging population have been completely unresolved. So political and institutional realities suggest the need to understand how the price level gets determined when fiscal policy doesn't fit into that conventional framework. So let's maintain the assumption that surpluses do not rise whenever debt rises. Instead, let's assume that surpluses are chosen for political reasons, or maybe to stimulate the economy or to do something other than to stabilize debt. And so we can just, for now, go ahead and treat them as if they're exogenous. Now, in the conventional thinking, exogenous surpluses would mean that there isn't any equilibrium. Because remember, in the conventional way of thinking, surpluses in the future are tightly linked to what happens to debt today. So going back to one of the expressions that we derived before, this left-hand side is debt that's inherited, the real value of the debt that's inherited. If surpluses are exogenous, and we're in this simple framework where the real interest rate also is exogenous, then this whole right-hand side is just some number. Some number. It's just whatever the current surplus is plus the present value of the expected future surplus. So it could be 6 or something. Well, this is an equilibrium condition where there's only one endogenous variable. B-1 is given, it's inherited from the past, so it can't adjust. By assumption, surpluses are getting determined by something other than the state of government debt, and the real interest rate also is unrelated to fiscal choices. So the only variable to be determined in equation 9 is the price level. So now we can ask, if surpluses are exogenous, how are the equilibrium conditions satisfied? The answer to that is that the value of debt must adjust. And the way that that happens in this simple environment that we're looking at is the price level has to adjust to make the goods value of outstanding debt consistent with the expected present value of surpluses, which is also denoted in goods. So this alternative framework posits that the price level is not determined by monetary policy independently of fiscal things. And it then shifts the focus from looking at the money market, as we have been doing, to looking at the bond market, which is what we will turn to now.